Welcome to everybody. My name is Sarah Corley. For those who've not met me, I'm Divisional Director at Digital Frontiers Institute, and I run the webinar series. And it's my pleasure to welcome you all onto this webinar today, where we're going to talk about ESG, a risk or opportunity. And some of you will know what ESG stands for. Some of you may not know very much at all, and that's absolutely fine because that's a massive part of our conversation today. This is something that is new and beginning to get more and more on the topical discussion. So being David and Jesse are going to tell you a little bit more about what ESG is and explore some of the questions and really sort of try and unpick whether it's a risk or opportunity. Today's webinar will particularly focus on financial institutions in the Global South. So we know there's more information, more focus, more noise happening on this issue in the Global North. But today we particularly are really excited to see most of our participants from the Global South, because we're keen to get your views, thoughts, questions, challenges, issues, comments as we go through this webinar today. A couple of housekeeping points before I officially introduce our guests that are with us today. We are recording today's session. So if you do have any internet challenges, or more importantly, you really enjoyed today's conversation and want to share it with others, you'll get a link sent to you by email within the next day or two that you can then share with other people or catch up and rewatch the recording. And we'd be delighted for you to share the recording as many people as you can. The more people who know about this topic, the better. And also, we are very, very keen to hear your questions, comments, or thoughts. Please, if you can, use the Q&A function, which you'll find towards the very bottom of the screen. So that way it just helps us monitor your questions and comments and be able to help us reply to as many as we possibly can. Also, please feel free to use the chat function to say who you are, where you're from, so that we can also gauge what different countries and continents we have on this call, because I'm sure we've got many different people and representatives on the call today. So firstly, I want to introduce our two guest speakers. I'm sure one of our first speakers, David Porteous, is not unknown to many people on the call. Many people would have been taught by David or been in class calls and things with David, as he is the chair of Digital Frontiers and also one of the teachers on our courses. But also now David has started a new organization, and he's the CEO and founder of Integral Governance Solutions. So welcome, David.
Thank you, Sarah.
And I'm also delighted, first time on a DFI webinar, but I'm sure it won't be the last time. We've also got the wonderful Jesse Fripp, and Jesse is the principal and CEO at Shining Rock Ventures. Welcome, Jesse.
Thank you, Sarah.
Fantastic. So we are going to kick off today's conversation by firstly doing a little bit of a poll, because we want to know what you know about environment, social and governance, ESG, and the frameworks that are being increasingly applied as part of funding, but also we've seen regulations change. For example, we know now Central Bank of Kenya, for example, has introduced regulations trying to gather information around these kind of topics in particular. So let's start with the poll. I hope you can all see the poll. I'm about to launch it, and I'd love for you all to give your feedback. So there is going to be a poll just launching now. Here we go. So hopefully you can all see on screen the poll. There's two questions there. Firstly, how would you assess your own level of knowledge of ESG frameworks? And secondly, if you scroll down in there, what do you think the level of impact of ESG frameworks will be on financial institutions? Are you all able to see the poll? And if so, please vote now.
Perfect.
Excellent, excellent. So we can see from question one that we have some familiarity. So about 16 of our audience are familiar. We have one who is very familiar. So that one person, we're expecting lots of great questions from you. But an awful lot of our audience, over half of you, have heard the terms, heard some of it, but really don't know exactly what it means. And that's absolutely perfect, because that's why we've got David and Jesse on board for that conversation today, to give you some more knowledge. In terms of question number two, what do you think the level of impact of ESG frameworks will be on financial institutions in the Global South? The vast majority of you, 53%, definitely material. But also a significant number of you, 27%, don't know enough yet to make an answer to that question. And so we'll be coming back and asking a very similar poll at the end to see whether David and Jesse have been able to tell you a bit more and help you think through some of those risks and opportunities as we go through our conversation today. So really interesting results. Thank you so much for everyone to sharing your results in the poll.
So good morning, good afternoon, good evening to all of you. Thank you, Sarah. Thank you to all of you for the opportunity to talk about this subject, which we do think is of rising importance in the digital finance community and the financial sector worldwide. And I'm glad to see, even in that first poll, that it seems like the majority of you already believe this is material. The question is, in what way? And as Sarah said, those are things we want to talk about on the session today. So the discussion today comes from a project, a broader project, which is supported by the Dutch Development Bank, FMO, and the Swiss Capacity Building Facility, and our thanks to them. Project where Jesse and I have been exploring this broader question about the implications of ESG, or more generally sustainability frameworks for financial institutions. And this first step is really about understanding how are people who are leaders of financial institutions in emerging and developing markets, or the global south, as we'd call them, how are they thinking about these frameworks and what might they mean? So in this webinar, we want to just address in the next 20 minutes or so these questions about what it is, what's behind it, what are some of those frameworks, where in the poll, many of you indicated you might have heard of some, but aren't too sure of what they are. And then, of course, then to explore the so what question. What might this mean for institutions, financial institutions in the global south? So let's kick off with the first question about what is it? Well, ESG is a term that goes back some 18 years or so to the United Nations Secretary General, and picked up in the UN PRI, the Principles for Responsible Investment, which explicitly adopted this term ESG. But I have to tell you, all these years later, there is still no consistent single definition of what ESG means. Instead, there is some convergence around the nomenclature, at least. So the one thing we should be clear about right up front is that ESG tends to be a term that's used more in the investment community, whereas the term sustainable finance or responsible finance or investing is often more used in the financial sector itself, among banks, for example, insurance companies. But the terms have come to be broadly equivalent. Now, if we say, what does that mean? Well, the pillars of ESG, or indeed sustainable investing, are those shown there. And you can see the reason for the acronym. Environment, the first E, we'll come back to that. Social, referring to workforce issues, as well as impacts on clients and value chains, for example. Governance, factors, how an organization is governed, not only about its board, beyond that. And then a new E, so some people talk about ESG plus E, which is the economic pillar, sometimes called the prosperity pillar, which is where you attempt to put the whole back together again, having unpacked these individual impacts on a firm or a firm on these issues, environment, social, and governance. Then how does the firm contribute to overall economic prosperity? So under the environment, as I promised, in some ways there's been the most development in the last 5 years of frameworks, terms, ways of thinking, indicators, and generally seen as falling into these three boxes: climate mitigation as perhaps the most active part, measuring emissions, for example, carbon pricing, all sorts of things connected to that as part of the low carbon transition. Climate adaptation is very much part of the whole environment story under this more general rubric of climate. And then you can broaden by adding this big bucket, this growing bucket, where, for example, the Task Force on Nature-Based Financial Disclosures is active today. And those make up the more general set of green concerns under the environmental bucket. And you can bucket it further into environment plus social. And so you can see a whole taxonomy emerging where, at least at this very high general level, there's some convergence about what it means. But when we look under the hood, we'll find that that's not the case. So if that's what it is, at least to start with, what's driving ESG today? And the first force is the force of investment. Now, what you see on the screen here is a graph from a recent institutional investor article, which looks over time, since 2016 to 2020, at the volume of funds, and the figure there is $58 trillion, which operate under different types of ESG mandate. And you can see that the biggest ESG mandate is what's known as integration, which is where those three factors, environment, social, and governance, are integrated into the investment process, the decision to invest, and then the ongoing monitoring of the investment, considering them as potential risk factors meant to be as opportunity as well. That's a different strategy from an ESG strategy, which has a negative screen, which might say, for example, we don't invest in fossil fuels by way of screening out what we consider to have a negative effect on one of the ESG pillars. Engagement, a strategy where investors believe that through engaging with companies, they can see improvement in ESG. So they engage specifically around ESG policies and strategies at companies. And then importantly on this list here, you can see impact investment, which has been around quite a long time, but where there is an explicit concern for a net positive benefit. The other frameworks would tend to say you can't do this, or you need to consider these issues and balance them out or engage around them. But impact investing would look for a net positive benefit in a particular area. And it is the smallest of these categories, under $1 trillion, these of funds under management at the moment. Now, the really important thing about this is that these numbers are growing, and growing quite rapidly at the moment. Not only are the numbers growing, but the application is growing. So in the early days, ESG was applied specifically to public listed equities, and then to listed bonds, for example, country sovereign issues of bonds. Now the application has broadened far beyond that into other classes like private equity and even venture capital. So this really is a first force shaping the landscape. It's a force coming from the investment world. You may be asking, all this emphasis on ESG sounds okay, maybe. We'll discuss that some more. How does it link to these sustainable development goals, those targets which the United Nations agreed on in 2015 and set for 2030? Well, it's been something which the investment world has been grappling with in recent years, because there's generally agreement that ESG tends to focus more on the processes underlying those issues of environment, social, and governance and economy, whereas SDGs, of course, are concerned about outcomes, those targets, those societally agreed indicators of where we would like to see as a world impact in the 17 defined goal areas. There's been some concern in the investment world of late that a focus only on ESG can tip things towards a concern about risk-return profiles and not about positive outcomes. And so there has been work done in more recent years by the likes of UN's PRI, looking at how to integrate SDGs into the framework of ESG. And here's one way to see how to do that. This actually comes out of a very recent national roadmap from the Philippines. And it shows, as you can see in the tiles, the SDGs. There's number 1, at the top there, number 17, and it layers them in a 4-layer cake, so to speak, and you can very easily map what we've been talking about into these layers. The environmental layer dealing with the biosphere, the SDG targets there, the societal layer, the economy layer, and then you could argue that number 17, partnerships for the SDGs, is very much around governance and how that works together to achieve the SDGs. So in theory, these two frameworks should interrelate and should fit together. So there's the first big force. Here's a second. The second is growing adoption by domestic financial authorities of ESG frameworks. And this means that these international frameworks that we'll look at in a moment are increasingly coming onshore, if you like, coming soon to a theater near you, as they say in some places. Now, to date, a lot of the activity has been in the global north, in Europe, for example, which has led the way with laws like the Sustainable Finance Disclosure Regulation, now in force, which has created a whole host of taxonomies, which are now being finalized as to what is considered green, for example, which is part of avoiding the risk of greenwashing, where investment funds claim to be ESG funds, but in fact are not in substance. That's also been a concern in the US, where the Securities and Exchange Commission this year has two proposed regulations, one dealing with the risk of greenwashing, the other introducing climate disclosure for large listed US companies, something which Europe already has and is evolving further in the Corporate Sustainability Reporting Directive, which will come into force in a staggered way over the next few years. Now, that sounds like a very northern issue, and it has been. However, there are a whole lot of ways in which it's broadening out well beyond the global north. One way is the Network for the Greening of the Financial Sector, which is a group of regulators, largely central banks, which now includes a number of central banks from the global south. Even more specifically, the Sustainable Banking and Finance Network is a network that has 62 countries which are only emerging and developing market economies in the global south. And that network has three pillars to its activities. The first is ESG integration, which is about ensuring that the environmental, social, and governance risks are brought right into the governance, operations, lending, and investment of financial institutions. And from the latest SBFN report 2021, you can see there that 32 developing countries have so far included ESG specifically in their national frameworks. And we can talk more about examples of that. Sarah, you mentioned Kenya, which has included a particular aspect relating to climate. Others, like the Philippines, have gone broader than that around ESG as a whole. So there's the second force. We have investors as a big drive over the last 10, 15 years, accelerating, domestic regulators accelerating in the implementing of ESG frameworks domestically. Now, those of you who've done CDFP or other courses with Digital Frontiers would already be familiar with the number of international standard setting bodies that they are, the likes of BIS, for example, for banks, and FATF in areas like money laundering. Well, this area of ESG brings a whole set of new potential and actual standard setting bodies to the party. And these bodies are doing what standard setting bodies do, which is to pass frameworks, sets of guiding principles, which can then be adopted into domestic laws and standards relating to ESG. Let's take a quick look at a few of them in recent years, just to select a few. So UNEP FI, Principles for Responsible Banking, a more specific version of the general PRI framework. 2020, the WEF, developing measuring stakeholder capitalism indicators. And then this process of SDG disclosure to mesh it with ESG, brought about by the Value Reporting Foundation. Now, the Value Reporting Foundation has been merged into a body we'll hear about in a moment, but here's another one, the Global Reporting Initiative, which convenes the GSSB. It reissued its set of reporting standards in 2021. And this year alone, we've seen a couple of very significant sets of standards drafted. First, the IFRS, the International Financial Reporting Standards, which apply to most countries of the world. So if you don't think this yet applies to you, by the time these exposure drafts, which have just closed for comment, in fact, very recently, June, as soon as they become final drafts next year and are released, they would start to apply to firms well beyond the financial sector as well around the world. And then we have the European Sustainability Reporting Standards, which have often led the way, as they have in other areas like GDPR around the world, coming up with standards in different sectors as part of the new European Corporate Sustainability Reporting Directive. So if you think there's an alphabet soup of things out there, well, you're right, there really is. There's a lot going on. And the question is how to make sense of this and how to make sense of this in a way that you can responsibly create local frameworks that apply. So here's an example. The Joburg Stock Exchange at the end of June. So again, this is all very recent developments that we're talking about here. They published their sustainability disclosure guidance. This applies to all listed companies, all new issuers at least. And it did so by looking at those international frameworks and saying, what do we do here? What do we need here in South Africa, where the Joburg Stock Exchange is? And they looked at a number, but let's just extract three that we've talked about on the previous slide, really just to illustrate how they're similar in a lot of respects, what they expect to disclose, what they expect guidance should be given about, the reporting principles, but there are some differences and they're important. For example, the issue of materiality. So IFRS, the global standard for accounting in S1, the general standard, S2, the climate standard, they talk about single materiality. So they require companies to disclose what the impact is of those ESG factors on them. Whereas the European standards talk about double materiality. So the causality works both ways, both from the outside in and from the inside out, how companies impact on those factors in society. You can also see how the metrics differ. So IFRS now introduces a whole lot of measures around climate because it's specific to climate. Others will be coming around the S in future from IFRS. And the Europeans are working on their standard, their drafts as we speak. But these are areas in which companies will be expected to be compliant. So let's take a very brief look at one specific disclosure framework. This is not IFRS, this is SASB, the Sustainability Accounting Standards Board, which has been integrated into IFRS. So we have mergers going on here at the same time, some convergence among the standards. But what SASB does is it comes up with reporting standards around ESG, around sustainability, sector by sector. And so the table you see here are the SASB standards for commercial banks around the world. So SASB looks at what are the material topics, if you're concerned about ESG, that you should be reporting against. And for those of you concerned about financial inclusion, you can see financial inclusion features there. You can also see that the SASB measures are pretty basic, number and amount of loans for small business and community development. No cost retail checking, that sounds like a very northern, possibly even very North American type of measure as a quantitative measure, but there are a whole lot of others as well. How you integrate ESG into your credit analysis, that's a discussion factor, and actually disclosing it, that's a quantitative measure. So you get a sense that these global frameworks are quite broad. To those of you who've been used to impact reporting, may even look quite rudimentary compared with the work that's been done over a long time in microfinance, brought within the impact management project, which seeks to look more deeply into some of these issues. The risk will be if you only follow some of the reporting that's evolved around impact and miss some of these broader issues, the reporting will no longer be considered adequate if these frameworks are adopted into the required regulatory frameworks for disclosure. Let's just acknowledge, as we move to think about the so whats, that ESG has become controversial. You would expect that as it's grown so large, so fast. Some of you may have seen this recent Economist cover story with this quote from the story saying ESG approach is broken. It needs to be streamlined and stripped of its sanctimoniousness, a very Economist style barbed kind of thing. But there are a number of ways you might critique ESG. Some say the ESG ratings, S&P's ESG index, for example, are inconsistent. Tesla got chucked out this year. Exxon came in. Why? Some would say the factors themselves under ESG are not clear and not coherent. Arms manufacturers were considered taboo by some, but came back into favor as some considered them part of democratic governance after the Ukraine invasion. Many say it's difficult and costly to measure ESG, and even subjective. One investor said it's like measuring your favorite child. Of course, there are these concerns about greenwashing that we've mentioned, and in fact, regulatory action being taken in jurisdictions like the US and the EU right now. There are reasons to be at least concerned about whether there's a simple win-win here or whether there are trade-offs, partly because the ESG measures themselves are not stable and established yet. And there are those who are concerned about the ways in which ESG links to this broader stakeholder capitalism agenda promoted by the likes of the World Economic Forum, which some regard as being woke capitalism. So there are lots of reasons why you might have at least some questions to ask. The question we want to ask, though, Sarah, today is this one, which is to say, hearing about these frameworks, are they themselves a material issue for financial institutions based in the global south? And this whole word material is in fact a very important word in ESG frameworks because the focus is meant to be on material. And that's defined as material if it affects the ability to create value in those timeframes. So just to finish, how might ESG, as we are seeing it emerge, affect the ability to create value in the short, medium, and long term? Here are just some thoughts of ours as we start this conversation today. It will affect disclosure requirements, and that's likely to come sooner rather than later, largely through the channel of IFRS, and in some cases, domestic regulators more and more. As a result, it will put a burden on financial institutions, which will require them to increase capacity. Capacity not only to produce the disclosures, to engage with shareholders, but to participate potentially in consultations around this, which are happening as we speak, even in some of these areas. We think it'll be linked to increasing social activism. So even if you don't have ESG frameworks in your country, if you have multilateral investors investing in, for example, microfinance, social activists can hold those investors responsible, such as in a recent complaint to the IFC about microfinance institutions in Cambodia around the S part because of their lending practices. We expect to see more and more of that. We're already seeing it. It's likely to happen more and more. It's likely to change access to capital, but how? For some who are able to fit into the disclosure frameworks, it may increase access to capital. For those who can't or don't, it may constrain access to capital. And then perhaps in the long run, thinking in these ways, defining pillars, indicators, is likely to shape an understanding of what impact looks like, possibly redefine notions of impact. And that will have implications for the long run in fields like inclusive finance. So with that brief introduction, what I'd like to do is just hand over to Jesse briefly to pick up on anything I may have missed in this conversation before perhaps we can engage further in thinking about those implications. But thank you. Jesse, over to you.
Thank you, David. And I don't think you missed anything. I would like to take the opportunity, maybe as sort of a co-discussant, just to highlight a few of the points that you raised, and perhaps take a first stab at answering a question that has come up in the Q&A. And I also noted at the top of the call that our colleagues and partners from FMO and the Swiss Capacity Building Facility are online, or at least they were not too long ago. So would also like to take the opportunity to invite them to make some comments in just a moment. But I would just pick up perhaps on a couple of points that you raised, David, in your briefing. One from slide 3, this element of the E and the emerging sort of environmental focus and standards around in the ESG frameworks. You noted in the cascading diagram that much of that focus currently, as we've seen it evolve, has been on the mitigation elements and standards and practices around that aspect. And I think one of the genesis points of this conversation was really a series of questions around the adaptation and resilience elements that arguably, you could argue that pro or con, have more bearing on vulnerable populations in the global south, and particularly the financial institutions, payment service providers, and others that are sort of on the front line of supporting those customers, those communities, and how to bring that sort of perspective more strongly back into those emerging standards. I think that's one point we'd love to hear from people on. I think the other aspect was around slide 4, and you touched on this interesting dynamic, which again, I think we would like to hear from our participants today on a bit more. That the implications have sort of two aspects. One that we might describe as sort of the implications on the sources of capital. If you're looking at sort of investment that is originating from DFIs, for example, you touched on IFC, others, and also private investors. Of course, GFANZ was launched at COP26 with an explicit call to public and private capital markets and investors and managers to target investment into the ESG space, with potentially tremendous implications. The other aspect of that, of course, is the uses, what we might describe as the uses of capital, which is where capital actually hits the street in the retail markets, and the implications for regulatory action and adaptation of ESG standards as they evolve in those markets. And I think we would hope to see emerging conversations happening at that level, but we would love to hear from, again, the participants about that. I think the other aspect that I would touch on is, and I think you highlighted as well, David, is that the E and the S of ESG are really outcomes oriented. They're trying to, or outcomes or compliance, and or compliance oriented as they're currently framed. And G, the G is sort of the process through which those outcomes and compliance objectives are achieved. And so that has tremendous bearing in terms of how prepared are the governing structures within financial institutions in the Global South to engage in these emerging standards, engage with regulators. It has implications on the audit and compliance sides of those structures, as well as on the strategy and finance side, if we're looking at risk and opportunity in this discussion. And I would say, sort of finally, I think we see, or we hope, that there is an opportunity. We'll talk a bit more, hopefully, about ISSB and the implications of that. But the comment period, for example, for the ISSB Standards 1 and Standards 2 just ended July 29th. Standard 3, which really focuses on S, we hope will be open for comment early in 2023. And so that also presents an opportunity, I think, for participants on this call and more broadly to really be prepared to engage in those conversations. I would note that I think I saw something recently sent out by the Ifrs and ISSB that they received over 1,000 formal responses to those first 2 comment periods. So that's encouraging, but we are yet to see exactly what the implications of that are. So stand by. Again, this is a fast emerging area, and I think we should be seeing more soon, but we can also anticipate opportunities to engage. There was a question, just shifting gears from some of those quick comments from Betty in the Q&A about how the triple bottom line conversation around environment, social, profitability intersects with ESG. I think Betty mentioned the early 2000s. I'm an alumni of Shore Bank Corporation and Triodos Bank in my past lives, and I would say that I would argue that maybe those conversations actually much predated the 2000s. You could go back, the 80s perhaps we could pick. I mean, you can mention institutions including Grameen, BRAC, KREP, and Equity Bank, Mibanco, Shore Bank, and Triodos I already mentioned, who were in some ways, I think, pioneering or in the vanguard of some of those conversations. And those evolutions, I think we've seen in this convergent path that David described through the microfinance standards, GIN, IRIS, social development or sustainable development task force, those microfinance standards, many of them emerged into the impact management project, which then merged into ISSB. So I think, again, convergent evolution of all of those standards continues. And I think that would be my first response on that question. So maybe I will stop there. And I think we wanted to invite Carolina and Satara to comment.
Okay. I'll just have to allow them to speak because only in a webinar function, we can only speak between the three of us. So
okay.
Just see if I can, while I'm promoting, David, did you want to answer one of the other questions as well there?
Sure, I'd be happy to, Sarah. So Gettina, your question is about, with reference to the social activism I mentioned in Cambodia, who is responsible for monitoring MFIs who aren't doing responsible finance? So first of all, just to say, I hope I didn't give the impression that social activism is a bad thing. The implication was just to say it's a rising thing, because I think that type of activism can be a way of enforcement where there is inadequate enforcement of responsible lending standards, for example. But I think my own view would certainly be that the responsibility for that type of market conduct, which can become a prudential issue, should lie with a regulatory authority. We've seen how self-regulatory authorities struggle with dealing with some of those issues, and that ultimately some form of sanction is required. And that means a regulatory authority, whether or not a specialized one. South Africa has a specialized credit regulator that deals with these things. Other countries have put it more into the market conduct regulators brief, but it seems to require that sort of authority. And maybe I could pick up Sarah Chris's question here. As a board member in Uganda, Chris, where do you start with ESG? Well, I think you start with at least a briefing. If you think it's material for your institution, especially, for example, I would argue if you're looking to raise money internationally, I would argue it's likely to be material, because funders, at least funders that come from Europe or the US and other countries too, will increasingly be looking for forms of compliance with ESG. So I would argue start with a briefing. And it's one which, Chris, if you are willing to do a short questionnaire as part of this broader project, we'd be happy to supply a short briefing, which may be a starting point for your board to start thinking and discussing what are these issues, how do you focus on them, and what do you disclose in future?
Great, so let me go to Satara first. Satara?
Sure, thank you very much, Sarah. Jesse and David, nice to be on the call. I think one of the most important things for us is, and the reason we funded the study is situations like the one that IFC was faced with is huge. And I don't think that there are enough, whether it's microfinance institutions or fintechs or insurtechs for that matter, that are aware of this. And I think microfinance does a huge amount of good, or financial inclusion or inclusive finance, whatever you want to call it, has a huge impact on low-income populations. And we would not want something like this to take them off their heels and not be able to deliver on these financial services. They're critical to many different economic drivers, both in their economies and globally. So I think this is really timely, and thank you to David and to Jesse and to Digital Frontiers for really coming up with this, and to FMO for supporting the funding here with us. I think it's a really important subject, and let's keep going on this, and let's get the awareness out so that the microfinance sector doesn't get hit hard as it has been hit in the past, and crippling economies or crippling these low-income populations. So thank you.
Great point, Satara. Thank you.
Thank you, Satara. And let me also introduce Carolina. Hi, Carolina.
Hello, can you hear me?
Yes.
Yes.
Hi, nice to see you all. Thank you for organizing this super interesting webinar. And I just wanted to comment on the evolution of this ESG. It's good to hear Jesse, sharing his experience from Triodos and earlier. I can very much relate to that. I worked in Mi Banco and was part of that journey. So I remember those days, and I'm seeing nowadays how this conversation and field has evolved, and is quite incredible. And one of the major shifts that I've been seeing has been the involvement of regulators and central banks in this discussion. And it seems that there are new models emerging. So we maybe can identify at this moment four, on how ESG is being integrated in financial institutions. So you have the compliance model that is basically coming from regulators to banks or MFIs as a mandatory aspect. Then you can have an inclusive model that is more of a stakeholder engaged model that includes different perspectives, and everyone finds its own way to comply and agree among different groups. You can also see a pioneer model where there's one entity that decide to start this journey, and then they bring other stakeholders along. And also then you can observe a collaboration model that it's more it could be similar to an inclusive model, but it's more of a how do you say, more of an agreed wish or need to move forward together on this specific journey. So it's it's good to see that this field is evolving so much with more and more stakeholders from the private sector, government, and also civil society.
Great, thank you so much for your comments there, Carolina.
Yeah, you're welcome.
And I'm going to jump into the chat here because I think Stefan and I have got a lot in common. He's asked one of the questions that, in fact, I was one of my best things to worry about, really. Having worked in the development sector for quite a while, there's a lot of, when you get funding, you also have to do a lot of monitoring and evaluation, and that has created industry, right? There are people whose jobs are entirely, and degrees even, are entirely around things like monitoring and evaluation. And I have absolutely no doubt that we need to do some level of monitoring and evaluation and impact and tracking, because obviously otherwise we're not sure that we are making impacts. But I am sure that, and we know that things like, monitoring in whatever form that takes is costly. And while you're spending money on doing the monitoring, you're still having less money potentially to spend on the innovation that might be reaching, that smallholder farmer, for example. So how can we sort of look at the balance between the cost that this might have and, and I guess like try and do it in a balanced way. I'm also thinking of the similarities with KYC. Yes, we need to know who people are because it's really important for anti-money laundering. But if we create rules that then exclude people from access to financial services because they don't have that one piece of paper that we have all decided globally that is really key, that can introduce problems as well. So David, Jesse, I'd love to hear your thoughts on that. Jesse, do you want to go first?
Well, I think, this is a very rich conversation, and I also noted Stefan's question. I think it's probably one of the critical questions, right? And I think David alluded to it, and also Satara mentioned as well. I think we have the recent experience, for example, in emerging markets of implementing IFRS 9 and 16 standards, which were sort of just, in my experience, sitting on a couple of inclusive finance bank boards that were overseeing that implementation. it was really just sort of adopted willy-nilly and just pushed by regulators for various reasons in emerging markets into the banking sector without being right-sized. Really, I would describe it to the realities of those market environments. And yes, they come with significant cost. I mean, anti-money laundering and counterterrorism financing regulations similarly were sort of rolled out without perhaps or arguably those considerations. And I think that's why these comment periods, these conversations, and sort of engagement from the users, shall we say, the folks on participants on this call and others, to really engage both through dialogue with their market regulators, dialogue with investors, dialogue through networks and associations such as this one, and many others that are actively engaged. I think ensuring that those perspectives are there. I'm maybe crossing over the line and demonstrating some of my own biases here, but I think those are opportunities. I would say potentially to mitigate those risk elements. I think that Stefan really rightly raises, because we have recent examples, relatively recent examples of those impacts playing out. So there's reason to anticipate that a similar outcome might occur in this instance. And I think the ethics of mitigation focus within the E and how compliance to those standards might impact or could impact the the clients in emerging markets in the global South who really are on the receiving end of the crisis and not the creating end of that. I mean, I think that is a huge question, and I think that's also one of the the questions that we're hoping to get into more through these conversations and this study and this initiative is really how to bring more of that adaptation and resilience perspective into the conversation, so that the E standards become more balanced and more representative of those realities that affect are somewhere between 1.5 and 2 billion of the world's most vulnerable population, who are largely in the global South. So I think, I don't know, David, over to you.
Yeah, so I mean, maybe just to build on that, Jesse, and also pick up a question I see from Samson, which is related in the questions here. I'm glad you, Jesse, mentioned the long history of thinking about triple bottom line, but the whole point about this ESG thing is the way it's consolidated around these pillars, these defined separate pillars of E, S, and G. It's only starting 18 years ago, and the reason that matters is because the way we frame things will affect the way we behave, right? And I think, as you're saying, framing E as a distinct separate pillar very much doesn't meet the realities of what's going on in the ground, where climate adaptation affects the S, as you're saying. And I think that's at the heart of Samson's question, asking about how do you manage regulations for green financing without reducing credit? So Samson, that trade-off that there could be, if there were to be strong regulation that limited the supply of microcredit in countries like yours, I assume you're asking. So that seems to be where I think what Jesse is saying about how one engages around, as these frameworks are coming onshore, because they're likely to be coming onshore in many countries in the next 5 to 10 years, engaging with regulators to manage those trade-offs carefully. The Impact Task Force, which is the G7 body that reported last year around these things and recommended accelerating to the application of these frameworks to converge them and standardize disclosure, all those good things. They talk about a just transition. And a just transition is where one manages those trade-offs and recognizes that there really are trade-offs such as the ones that you talk about, Samson, but what that looks like in your country and what that means in terms of adapting the regulations in your context, those will have to be thought about. And I guess, Sarah, if we have one message today, it's about the importance of starting to think about those issues, because I do remember the early days when I was approached. In fact, I was in South Africa then 20 years ago, and Louis de Kruger, a professor, came to me and said, this AML thing, it's small, but it's coming, and it's going to have a big effect on financial inclusion. And boy, was he right. It really did. not necessarily a bad effect overall, but we went through a lot of issues that had to be worked through to optimize how it would work before we could come out in achieving its intent. And I would say we're looking at a very similar situation with ESG.
So definitely, this is a time for us to act, to think, and to make sure that the voice of the Global South is heard, right? Because otherwise, we are going to end up, not sort of, with the potential, I suppose, for frameworks, for regulation that has kind of been copied and pasted from the North, tried to apply in the South, but in actually an incredibly different context, which is why I always think of, my biggest example of that when I think is GDPR, that how actually we can't just copy what works in Europe works there for certain reasons. When you can't compare a country like Eswatini with America or with UK. The situation, the context, everything is going to be quite different. And I think this is quite nicely links us to Kabir's question that just came in, and it might be the last question because I know we're getting close to the hour. But Jesse and David, if you can throw in any other answers to any other questions in the answer to this one, that will be wonderful as well. But Kabir asked the question, how can we measure this holistically, right? And I think and are these frameworks going to allow each country to be able to answer with the data that they have in the context that they have, or are we going to have something that's incredibly standardized, which is going to make it quite challenging for some to utilize the data that they have, and it might mean going back to the drawing board or having to search for data, or not even being able to find that data and give that data, and then thus these financial institutions suddenly get excluded in some way or can't provide the services they want. So yeah, how do we sort of manage this, and how can we contribute to try and make sure that ESG is an opportunity and not a risk or threat? David,
no, I think it's
Jesse, you go start.
Oh well, no.
Go Jesse, and then I'll ask David to round up for us.
Okay, perfect. Well, I'll try to do very brief justice, I think, to these big questions. I mean, that is, the purpose of this conversation today, I think, is summarized in large effect in Kabir's question. I think part of the challenge is that it isn't holistically measured currently. There are many standards. They're being adapted in different ways and applied in different ways. I think where the rubber hits the road, arguably, is in the regulatory context, in the market environment where the financial institutions are operating. So I think the hope is that there can be some. I guess the good news is that there is convergence of those standards in some sense, so that arguably creates some momentum towards reducing a confusing mishmash of different standards, and how are you picking and choosing and applying them, and in what ways. But it also creates this risk that we've identified of just sort of this top-down, arguably global north to global south, just application of standards that may or may not have real bearing or relevance entirely to those market environments. So I think the opportunity, I think perhaps again going back to the ISSB comment period, is where that intersection of social with the standards that are emerging can create a give and take dialogue, and perhaps some ability to say, yes, there are perhaps some global principles and guidelines for the adaptation of those principles in a way that it has relevance and bearing to the local market environments, could be one direction that conversation takes. But again, we are in the thick of it. ISSB, let's remember, is less than a year old, this new standard setting board. So this is a real-time conversation, but it is moving fast, as we've described. David, over to you.
Yeah, thank you, Jesse. So I would just say, by way of pulling together some of the conversation today, I guess our main argument is to say that the forces behind ESG don't look like they're going to dissipate or disappear. The force of investors, the force of domestic financial authorities adopting these frameworks. Therefore, it's something that needs to be thought about, because it may be, and I still use the word may, it may be material for you as a financial institution in the Global South. And so just to add to that then, in terms of this ongoing project here that we've spoken, so we really would love to hear from the voices of the leaders of global Southern financial institutions that are starting to think distinctively around this. You know, there are people who simply say, well, the frameworks are coming, they're inevitable, we should just adopt them. That's a voice, and that's a reasonable position. It has implications. We're interested in voices that might say, well, we are thinking a little differently. What might that mean? Just to understand what those voices are, so that this project can come up with a view on the range, the diversity of views that exist out there today in the Global South as part of this ongoing discussion, which will no doubt take the next 5-10 years as these frameworks proliferate and are enacted. So thank you so much for the opportunity to be in this discussion.
Thank you so much, David and Jessie. And for those of you listening to this conversation today, I really encourage you to click on the link that I just shared in the chat. We'll also pop it in the email that we'll be sending you as well, so that we can, you can contribute to the work that David and Jessie are doing, and also, learn more so that you actually feel like you're in a position to be able to contribute to the conversations as you feel you need to, and you feel is fit for your financial institution as time goes on. I just want to finish the call with another poll. Let's see your views and opinions and how we may have sort of changed those or have the opportunity to learn more, right? So we would love for you to talk a little bit about which are the aspects of ESG you think will be most material for Southern financial institutions, and also going back to the questions, do you think ESG is a risk or an opportunity? I'm launching the poll now. It will be great for as many of you to give us your thoughts as we can. And while the poll is up there, let me just very briefly say thank you very much, Jessie and David, for this fascinating conversation today. I'm pretty sure we could have continued for another hour having these conversations. There's a lot to unpick, there's a lot to discuss, but as we said as well, this is just round one. For those of you, those that are really interested in digging more into this, there is an opportunity to receive the briefing paper that you both have authored, co-authored and put together, and to be part of this conversation further. This is a great opportunity for us to have our voices heard. And Jessie, as you were saying, there are consultations out there as well. So, for us to be part of the shaping of a framework actually takes some of the risk, or tries to mitigate some of the risks away from us. There we go. Let me end the poll and share the results. So here we go. I hope you can all see the results there on screen. Access to capital and disclosure requirements coming up there as key material impacts. I think the upskilling probably will come later, right? If you don't know what you don't know what skill gaps are missing in some way. But in particular, those two key things coming up there. And we're actually, when you look at those results, we're seeing an even split between mainly opportunity, mainly risk, and most people saying a pretty even mixture. And I guess that's quite a healthy place to be. Nothing comes without risk, nothing comes without gain. Actually, part of the conversation from here on now is not arguing whether we need them or not, because historically we know that this has been going on, thank you, Jessie, since the 80s. But
at least,
right? So it's not going to go away, but actually knowing more about it and contributing helps us to mitigate those risks. So I really hope we've increased people's knowledge today, increased people's curiosity, increased people's desire to know more, and I really look forward to sort of maybe we can do a follow-up conversation on this once we start to see a clearer picture of what these frameworks might look like and how they're going to be applied in the Global South in particular. Once again, thank you, Jessie. Thank you, David. Thank you to everybody who joined us today, and we look forward to seeing you on a webinar again soon. Thanks, everybody.
Thank you, Carolina. Thank you, everyone.
Bye.
Bye-bye.